This is the current federal tax developments for the week of April the 8th, 2019. Current federal tax developments are brought to you by Kaplan Financial Education and your state society of CPAs. I'm Ed Zollers, broadcasting this week from Phoenix as normal, and we'll be talking about what's gone on in this week, the week before the deadline for filing the returns. One caveat: next week's broadcast probably will be different and may very well be delayed, as you may be aware. I do have a tax practice, and we've got a few things going on here, and this week will be kind of interesting. You never know what crises come up just before the filing deadline that somebody hadn't told you about. So we've got all those sorts of little things happening. So maybe a little delayed. I also figure you guys probably aren't going to be rushing to pick up the update quite as quickly as you used to. I am thinking for next week we may talk about where we stand on Tax Cuts and Jobs Act guidance at this point, kind of give everybody a review of where we are, what's missing, what's come out, and where we stand now that tax season is over, so we see what we're going to be watching for in the coming year. But this week we got a few things to talk about. Talking about things happening with the Tax Cuts and Jobs Act, we found out this week the IRS sent proposed regulations on Section 199 Cap A that relate to cooperatives to the OIRA. Remember those guys? They review all the regulations. Well, they're at that location, which means probably in the next month plus, we're going to be seeing proposed regulations coming out on the cooperative rules under 199 Cap AG. So if you've been waiting for those, hey, looks like there may get some movement. We have a program manager technical advice that outlines the interaction of how the home office and the SALT cap work with each other. We have the AICPA requesting some changes be made to the Form 461 instructions for the definition of what is a trade or business for the business loss rules under Section 461. And the Second Circuit Court of Appeals reversed a tax court case we discussed here back in 2017, where the tax court claimed to have discovered a black hole in the statute of limitation rules for filing for a claim for refund. The Second Circuit says, no, it's safe to go through that part of space now. So we'll talk about what the differences are and what happened there, and also whether this really does impact anybody outside the Second Circuit. We'll talk about why it may not. Again, hopefully you've been watching the beginning weeks of baseball. I know you guys are kind of into that, and it's also Final Four weekend. Those of you who listen to this on Monday, we'll be having the Final Four, the NCAA championship. I'm recording this Saturday morning, so I don't even know who's going to be in the championship game, but we'll see how that works out. Those of you doing later, you already know who wins that. So the baseball games will continue. So, hey, that's up. It's spring, and we all know that. That means it's time to get to the April 15th deadline when Major League Baseball gets started, and so that's where we're at right now. Let's start out with what is now the notice that was sent from the Office of Information and Regulatory Affairs, OIRA, related to the fact that the IRS had released proposed regulations. This is RAN 1545-BO90. It was posted to the OIRA website on April the 2nd. And what the IRS is now issued, think about where we stand on 199 Cap A, because this is kind of where we've been. I've been waiting for guidance on this ever since the Tax Cuts and Jobs Act came out, and we've got most of it. The IRS has already issued final regulations on most of 199 Cap A. The provisions basically that were enacted back in December of 2017 that were part of the original law. They also have, at the same time they issued the final regulations, they issued some proposed regulations on mutual funds and publicly traded partnerships and interactions of those with the rules for REITs, and those are still in proposed form. We don't have any note about when those will go final. But the one thing that's been kind of missing was that added by the Budget Act back in March of 2018, was the fix for what was known as the grain glitch. Now, you all remember the problem with the grain glitch was, if you don't remember how that worked and why it was such a big issue, was because it would have effectively meant that you had to be insane as a farmer to sell your crop to anything except a co-op, because automatically 20% effectively of what you sold to the co-op would be non-taxable. There'd be non-taxable revenue. It was like that was not really the intent of the law, but that's how the law read. So Congress went back, and as part of the budget bill enacted in early 2017, they put in the fix for the grain glitch. And this is found at Section 199 Cap AG. for practical purposes, that 199 Cap AG fix was really restoring, in many ways, old 199 for cooperatives, and then putting in a special subtraction that will be claimed by farmers who are basically selling to the cooperative and basically get allocated some of that 199 deduction to them. They will, in essence, be able to, they'll have to take a subtraction from their particular 199 Cap A deduction, but it's not really tied to how much they got. It's a complex issue. It's there. Nevertheless, what we have here is that the IRS never got around to issuing proposed regulations on how cooperatives were supposed to deal with 199 Cap AG. A major reason for that is because, to be honest, it was pretty much old 199 taken straight from the code and just dropped in whole into new 199 Cap A, but limited to applying to cooperatives. And I should say to agricultural cooperatives too. Not all cooperatives are covered by this. So the idea was we probably didn't need a whole lot of guidance. In fact, even Congress even says in section 199 Cap AG 6 that the IRS is expected to issue regulations that essentially duplicate the old 199 regulations that applied to cooperatives. So the IRS's theory was almost certainly, cooperatives were basically, the real thing that was impacted, cooperatives were still issuing basically the flow-throughs for old 199 for this year. You may remember that if you had a farmer, you probably had to do, you're the one group that got some old 199 on your return this year that kind of got plugged in a nowhere line. So they had to deal with that. That was mainly their issue. They're going to have to deal with this new G issue really next year. It'll be the major time we'll have to deal with it. And so the idea was that, well, we've got time to work this out. And so that's the idea the IRS took on. But they now have sent those proposed regulations on to OIRA. OIRA has them to review. They're in the review process right now. You'll find that you go to their website. If you want to follow these, if this is of interest, if you do a lot of cooperatives, obviously the fact that it'll be like the old 199 regs is not necessarily going to be, very helpful to you. You've got to see what they actually do. Do they make any tweaks? And probably of some interest, do they use this opportunity to go back and maybe tweak some of the things they did on the farmer side, on their side for reporting under these rules? Do they do some stuff there and give us some additional explanations in that area? Do they provide some special guidance? Again, we're all going to want to watch how this comes out. So it's over there. You can go to the OIRA website, and it's basically, if you just kind of search Google for OIRA, you'll probably come up with their regulatory dashboard. And there, if you go to Treasury, you could be able to follow this one. I've given you the site for what the actual citation is on this as to where you'll find it. And what you want to do is you want to watch that and see when it goes from pending to completed review. When review is completed, that means it's gone back to the IRS. The IRS has taken varying amounts of time, normally fairly quickly, but sometimes they've delayed a little longer after they get it back from OIRA before they issue the proposed regulations. And, quite often they will issue them initially before they go to the Federal Register. There'll be a posting on the IRS site. We've seen it that way this year. And then eventually the Federal Register link will come up, and then finally it'll actually get published in the Federal Register. So all those things happen. So you may want to keep an eye on that. Now, how long will OIRA hold it? That was not identified as one of those that the OIRA was going to process in a special 10-day rule. So probably the way this has worked in the past, and there's been different periods of time, the OIRA has held on to regulations that have not been flagged for varying periods of time, usually about a month at least, sometimes more. And then basically once it swaps, so you need to start watching. Okay, so probably the first takeaway, probably not something that's going to happen this week. I don't think they'll probably drop it this week, but you'll probably want to be watching it as we get into May to see if they release this. And then once they do, if this is your area of specialty, you want to make sure you take a look at those proposed regs when they come out. You're looking for any surprises or changes from the old 199 rules that may be there, and maybe some guidance on how this impacts on the other side, the special deduction. Do they do any changes there? And those will be things to watch for in these regs. Next, we have a Program Manager Technical Advice 2019-001. The IRS put the first two on their website this week. And this was technically published by the IRS internally on December the 7th of 2018. But the IRS pushed it to their website finally here on April the 5th. It deals with the interaction of the office and home deduction and the cap on the deduction of state and local taxes. So 280 cap A, which is limitation on using, claiming deductions on property used as a residence, and 164B, which has at the very end, which has now in it the special $10,000 limitation that we have on state and local taxes. So we're going to take a look and see how those things work. Now, you're all probably aware we've got these special rules for an office and home. Generally, we're looking at having a section of the home that is used exclusively for the business. And then we allocate to that portion of the home the various expenses, which includes a portion of the debt to acquire the home, the interest on that debt, a portion of the property taxes. Now, those, if you're itemizing prior to 2017, you would have probably gotten a full deduction for those, right? At least for regular tax purposes, and that's all we worried about. But now we've got a problem that the real estate taxes are capped along with your state and local income taxes or state and local sales taxes at $10,000. So what happens if you have an office and home, but you have, let's say, more than $10,000 of state and local income taxes, so you would not have really gotten a deduction for the property taxes anyway. How does that impact the rules? Well, that impacts because of a quirk of how Section 280 is structured. Section 280 has a special rule at Section 280B, 280 Cap A-B, I should say, not 280, but 280 Cap A-B, which it says that for interest, taxes, and casualty losses, the general rule that you cannot claim a deduction for expenses used as for property used as your residence for business purposes, you can't claim that business deduction, does not apply to any deduction that's allowed without regard with connection to the trade or business or with the income producing activity. And as the title of this subsection tells us, they're looking primarily at interest, taxes, casualty losses. Why that's important is this set of expenses are allowed to you automatically for the office and home. You get them, let's say it's on a Schedule C. Let's take the simple case. So you get a claim on the Schedule C, and we don't worry about any income limitation. Notice 280 Cap A-B never mentions a cap on income. So we get those deductions. The logic being that there's no need to cap those based on the income of the business because you'd get the deduction anyway. But what about now if you are stuck with that $10,000 cap? Well, what the IRS rules is if you are over the cap, or to the extent you'd be over the cap without without claiming these real estate tax deductions, let's say to the extent you're over the cap, I should say, with claiming these deductions, you cannot use 280 Cap A-B to claim these deductions. So let's say you've got that $12,000 of state income taxes and you've got $5,000 of property taxes. You're not going to be able to use B to get that special deduction for the property taxes. Now, if you read the summary, you can panic very quickly because it's like, oh no, we're going to lose those taxes entirely. That's not fair. It's taxes on a business property. Why can't we get it? And you go off the deep end. But there's a little footnote that it's important. You still can claim the deductions under 280 Cap AC. C is the general rule for office and home expenses that applies to your repairs, your utilities, any other expenses maybe that impact the home. And those deductions are limited, right? And they have a nice little table they come up with for how this limit works. And they say 280 Cap AC deductions are limited to your gross income from the trade or business or rental, minus the B deductions, right? Those interests and taxes and casualty losses. Again, we'll get back to the interest here in just a second. And then minus also deductions that were, not incurred in connection with the dwelling unit. So your general expenses for the business. And then if you got any income left over, then you can offset that remaining income from the trade, business, or rental by the office and home expenses. So the basic takeaway is this. Let's say I've got an example of a taxpayer who has $5,000 of property taxes, and let's put this person in Wyoming. So they have no income taxes, and I'm not going to worry about their sales taxes. Let's say they have minimal sales taxes. So they have like $5,000 of taxes total. Don't worry about any of this. They're going to get their percentage of real estate taxes. It will still be a B deduction. It will not be limited by income. Now, take the second example. The person has $12,000 of state income taxes and $5,000 of property taxes. Well, now we got a bigger problem. Now the issue is we'd get none of the real estate taxes if we didn't have the office and home. So in that case, none of the real estate taxes qualify for the B rule of skipping the income limit. But we could still get them under the C rule if our trade or business is basically profitable. So mainly it's going to impact if your business is not profitable. Now, third example on the line, let's say we have $8,000 of income taxes and $5,000 of property taxes, and $2,500 of the property taxes relate to our home office. We got a really big home office. So in that case, what's going to happen is, I should say actually that number is a bit off because we're too close. Well, yeah, we're too close. So let me change that. Let me go down to 7,000. Okay. So at $7,000, right, we have $3,000 of cap. 2,500 of that cap is used up by the taxes that are not part of the home office. That leaves 500 of the home office real estate taxes that are deductible under the B rules because we get that deduction anyway. The other 2,000 would have to go and be classified under the C rule. So again, you get them, that's how it runs. So basically, just remember, even if B doesn't let you in, you can still get your benefits under C. But understand interaction. It also points out a couple of other things. Number one, this is always applied if you claim the standard deduction. If you claim the standard deduction, you don't get to use a B for items that, for anything that's itemized deduction, which means the three examples they gave us, pretty much you don't get it. It also always has applied if, let's say, you had acquisition debt that was in excess of, if your grandfathered $1 million, if you're not grandfathered $70,000. Well, that excess acquisition debt would not be, the interest on that would not be otherwise deductible. So to the extent that gets into your home office, that part of the interest would also have to go under the C test as opposed to the B test. Now remember, C expenses, if you're capped, are not lost forever. They just carry forward to the next year. If you never have income, then yeah, they go away for good. But otherwise, they work just fine. The note also says, as I said, it applies. So any other thing that's capped, that also will include casualty losses this year. So again, the part allocable to your home would never have been deductible. So casualty losses this year are going to be an office and home C limitation. If you had a casualty loss that was partially allocable to the home office, then you've got the C limitation. So it's an interesting PMTA to read. You might want to go take a look at it, especially if you have any office and home situations. And also, please note, it does not affect the safe harbor. The safe harbor is not impacted by this. So if you have a client using the safe harbor for office and home, not really a problem. Next up, the AICPA has some comments on IRS on Form 461, right? The AICPA wrote a letter expressing concerns about the instructions to Form 461, limitation on business losses. The form, I do love the fact the IRS used that form number, is to calculate the limitation on losses under Section 461. So, the IRS at least was appropriate in assigning a number to this thing, right? Now, the problem the IRCPA has is these instructions say, an activity qualifies as a trade or business if your primary purpose for engaging the activity is for income or profit, and, important clause, you are involved in the activity with continuity and regularity. The AICPA points out that that sort of involvement is not really required for a 162 trade or business. They're suggesting that the language should be changed to say an activity qualifies as a trade or business if your primary purpose for engaging activity is for income or profit, and the activity is conducted with regularity, with continuity and regularity. The taxpayer themselves individually does not have to be involved in the business. Why is this important? Well, it actually, can cut both ways. If you have losses, then obviously you'd prefer it not be a trade or business. But if you have income, we're going to have, and I think the ICPA's main concern here is with income, It could be a passive activity. It could generate income. But if it's a trade or business, it should be allowed to be netted against your losses to get that limitation. For those who forget, limitation of 461, you cannot claim net business losses in excess of income, in excess of business income. So it's a net business loss calculation of more than $250,000 for a single taxpayer, single head of household, etc., married filing separate, or $500,000 for those married filing joint. Any amounts in excess of that are disallowed for the current year, carried forward as a net operating loss the following year. We'll see if the IRS takes up the AICPA suggestion and issues new instructions on this form, or if they leave them as is, but the AICPA is concerned. Note, we still don't have regulations. And probably, I think the AICPA is really just trying to get a jump on the regulation side of this and suggesting that, you know what, when you write the regulations, make sure you cross-reference 162 trade or business the way you've used it everywhere else. And don't suddenly try to impose a specific individual involvement rule here. The IRS probably could say, I should say the AICPA could say IRS may not like the result in some cases, and B, it's totally inconsistent with how it's been handled before. So yeah, we think maybe you want to do this a little differently. So we'll see how that goes. See if anybody pays attention to the IRS. Finally, we have the case of Borenstein versus Commissioner, case number 173900. The opinion issued by the Court of Appeals for the Second Circuit on April the 2nd, 2019. We had discussed this case before, back in 2017. And that was a case that was known. The tax court had basically created what they referred to, they examined the rules on filing claims for refunds for taxpayers who had not filed a return. And they decided that something that Congress had put in the law in 1997 in the Taxpayer Relief Act that was meant to resolve what was considered to be an unfair result that the Supreme Court had pointed out in Commissioner versus Lunder, that they were going to resolve that by making a subtle change in the law. Basic rule for claims for refund. General rule, you have 2 years after you pay the tax to file a claim for refund with the IRS. That's the general rule. However, if the tax relates to a return that has been filed, then you have 3 years from the due date, including extensions, to file your claim for refund, even if that's outside the 2-year period. Now remember, it's the original due date, including extensions. So if you file the return late, you don't get 3 years from the date you file late. You just reset that initial 3-year period. So the 3-year period, let's assume you filed for an extension. So you're going to have returns this year that are due on October 15th of 2019. That means October 15th of 2022 in your statute, since you filed the return timely. Now, what happens though if you just don't file the return? Well, if you don't file a return, then your statute shrinks to 2 years. And the catch is, the way the Supreme Court interpreted that in the Lunder case was that the 2-year rule was, applied as soon as the IRS issues a deficiency notice, that cut off your ability to bring in the return statute. So basically, if you filed so once they did that, you were barred. Even if you were still within the 3-year time period, you couldn't then file a return in response to that and file your claim for refund. Well, basically, in section 6512B3, the Congress attempted to fix the problem. Okay. And what they said, they added language to the code that said, where the date of mailing of the notice of deficiency is during the 3rd year after the due date, with extensions for filing the return of tax and no return was filed before such due date, the applicable periods under subsections A and B2 of section 6511 shall be 3 years. That effectively gives you the ability to file that claim for refund within that 3rd year, even if you hadn't filed the tax return. So that was nice. You could file your claim for refund within that 3rd year. We weren't limited anymore. But here's the problem we get into. The wording of that caused confusion. It said during the 3rd year, right? After the due date with extensions. What happened in this case was that a taxpayer had filed their return, not filed the return, I should say, but she had filed for an extension for the year in question. So She filed a return on, let's say, in this case, her return was due on this, and actually in her case, reality was her return was due originally on April 15th of 2012. She filed an extension that pushed the due date to October 15th of 2012. Now, she hadn't filed a return. The IRS finally got around notices and sent her a notice of deficiency in June of 2015. Now, here's your problem. That is more than 2 years after she paid the tax. So, right, she can't qualify under that statute. But it's not in the third year after the due date, including extensions of the return. So the problem is from April 16th of 2015 through October 15th of 2015, she was exposed. If a notice of deficiency came out in that period, she couldn't file a claim for refund. If they had gotten past October 15th of 2015, then it would have opened up. She would have had a full year after October 15th of 2015 to file their claim for refund. The fact that the IRS brought the notice of deficiency in that 6-month hole meant to the IRS, or I should say to the tax court, that suddenly we create a black hole. There is a 6-month hole where if a notice of deficiency was issued in that hole, you're stuck. There is that 6-month exposure period, and then you get another year to try to file your claim. You get another year where you could file the claim if the service had not issued notice of deficiency during that second year. So here's how it goes. What the IRS said was this, okay, I should say the tax court, Borenstein versus Commissioner, it was a public tax court case, 149 TC number 10, issued in 2017. The tax court said, based on a literal reading of the statute, that hole was there. Now, the Second Circuit, where this appeal went, said, we don't think that's totally clear. We think, and I think this is being generous to the taxpayer, but I also think it's clear what Congress meant, that that you could read this multiple ways. And because it was meant to be a relief statute, and because it could be read multiple ways, we think that in fact they meant she had until October 15th of she had until October 15th of 2016 to file under this provision. And the IRS, getting in that magic 6-month period, did not extend the statute, or did not basically create a situation where she couldn't file a claim for refund because of this crazy disappearing, reappearing statute problem. Now, that's interesting. And obviously, if you're in the Second Circuit, this case is going to control the Golson rule. But because a published tax court case outside the Second Circuit, we're going to have to wait and see if the IRS continues to pursue this. And then secondly, if they do, if the tax court will decide they were right in the initial case and basically dare the taxpayer to go to another circuit and see if they can get it overridden. So it's still a danger period for all of you not in the Second Circuit. And that's most of us. We still have potential exposure. Non-filers still have a potential problem under the Borenstein rule. Again, we'll just have to see if the IRS announces acquiescence, non-acquiescence in this area, or if the tax court decides to move forward, or if we just don't hear anything. And then it's going to be an interesting time period in that area, especially if you have collections asserting that, sorry, you're out of luck. There is no ability to file a claim for refund. You just owe us some money. Well, again, this is it, crunch time. And like I said, I expect next week I'll try to record a program that may not get posted till after the 15th, fair warning, related to probably where we stand on the guidance on the Tax Cuts and Jobs Act at this point in time. And so that'll probably be my discussion next week. This, though, is the time of year we're applying what we've learned. When you finish up, guys, okay, the state societies are beginning to post up their courses online. I've seen a couple of states. I've checked a couple recently, and they have their courses live. You can see them. You can sign up for them. So, consider looking down there and planning out this summer what you want to do for continuing education and later this year. And take a look at your state society offerings. We're going to be offering courses around the country with the various state societies. I'm going to be, as I say, presenting in Atlanta at the Decision Makers Conference, which is generally geared toward industry, on April the 24th. But we'll also have courses coming up. I have some coming up in Oregon in May. We'll have some other courses coming up in June in New Jersey. We're going to have a various set of courses coming up. And so, take a look, see what's available. and I've also got some coming up in Arizona in the mix of all that. So we'll have some other things flying around. So take a look, sign up for your courses, and we look forward to hearing from you and seeing you this year at courses that we are offering by Kaplan Financial Education. I almost said professional education. Officially, we're Financial Education Division of Kaplan Professional. So that's kind of how this works. This is Current Federal Tax Developments, and we are basically have our regular updates online at the website, currentfederaltaxdevelopments.com. May not see a lot posted this week, fair warning. It is that crunch week, so we'll see what's there. If you have questions or comments, you can email me, edzollers at currentfederaltaxdevelopments.com. On Twitter, I'm at Ed Zollers, so just add Ed Zollers as to follow me on Twitter. I usually post anything I post to the website will be there. Other tax discussions go on there. I do follow discussion groups, like I say, on Reddit, the Tax Pros group at /r/TaxPros. I follow discussions on Connect sites for New Jersey and Minnesota, along with my home state of Arizona. And I also follow along on California's Tax Talk site. I'll look in there from time to time. Those are great resources where you can find information. If your state society offers a discussion group, that's a really good place, especially for state-specific guidance, issues maybe with state tax matters that are always a little more fun to come by, but also for just general purpose issues and questions is a really good place to look in. And otherwise, I look forward to hopefully you all survive the next week. And like I said, my tentative plan right now is somewhere after the 15th to get out an update that deals with where we stand on Tax Cuts and Jobs Act. That's kind of what I'm planning. That way I don't have to do a bunch of write-ups. I'll be totally honest. I'm trying to get something that can be put out next week and give you something, and without that I can realistically do in that week. But you might check in. We'll talk about that. And otherwise, take care, and we'll see you back here the next time for Current Federal Tax Developments.